Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. And as usual, just want to thank everyone for attending this week's market update. We have a lot to go through. We've had a nice rebound in the overall strategies, the market as a whole as well. Now, today we got on the surface a fairly nasty CPI report, but we're going to go through that and kind of walk through some of the positives underneath that report, and also some of the very interesting and what we think are positive developments taking place even on down days in the market, such as today on Thursday. So let's go ahead and get started here. So I'm going to go ahead and share my screen. And, we're calling this week's market update our higher rates priced in. And the reason for that is in the month of January, as we all experienced, there was a painful adjustment as the stock market got ready for the Federal Reserve to tighten financial conditions by raising interest rates and by ultimately stopping the printing of money through the purchase of bonds. Those two events, in terms of the anticipation of the event, really caused a lot of volatility, caused asset prices to reprice downward. But as we actually get closer to the event itself, we're going to walk through how the market has already raised interest rates 5 to 6 times. So in other words, as the Federal Reserve raises interest rates, we're kind of just formalizing what's already been done in the market. So we're going to walk through that. And then secondly, what do we want to do with our cash and which is the most attractive option? Remember that cash has to go somewhere, so we always want to ask that very important question. All the instruments that we can use with our cash, including holding cash itself, what is the most attractive option? And lastly, we're going to review the current trading environment. I think it's important as we're going through these corrections and recoveries to make sure that the price action is aligned with what we think is taking place longer term with the fundamentals. So what do we mean by interest rates have already been priced in by the market? So when we look at 2-year interest rates, which is what this chart is, this is a chart of 2-year interest rates. What we see here is that the 2-year interest rate went from approximately 0.1% or so to 1.5% today. And we actually had to update this chart intraday after the CPI data came out. It was at 1.36 yesterday. So it's sitting at 1.5%. Why is this important? Because yes, the federal policy rate is important when the Federal Reserve announces the actual raising of interest rates, but the 2-year interest rate is where that is reflected, where those decisions are reflected. So in March, there's one of two things are likely going to happen. The Federal Reserve is going to raise by 25 basis points, in other words, 0.25% or 0.5%. Okay, so that would take the overall policy rate to 0.5 or 0.75%. Again, why are we stressing this point? Because the 2-year interest rate, which is reflective of what the market believes the Federal Reserve is going to do in the future, is already at 1.5%. So in other words, the market has already raised interest rates 5 to 6 times, because if we do 5 quarter-point hikes, we get from 1.25 to 1.5, and if we do 6 quarter-point rate hikes, we go from 1.5 to 1.75%. So part of the reason why I think you're seeing a lot of these secular growth assets do okay today, even though the market's really bad, is because a lot of it's already priced in, and people are now saying, okay, once the Federal Reserve's done hiking, what do I want to buy? And the mindset is already starting to change toward that direction. And we see that here with the yield curve. So when the yield curve rises or is steepening, as we see here in the first part of the chart, that means the market is anticipating rising growth expectations. In other words, the economy is accelerating. But if you remember, one of the things from our outlook this year for the entire 2022 is that we expect growth to decelerate. Why? Because the Federal Reserve needs to cool growth down in order to bring inflation down. What have we seen really, if we look at it, since the middle part of last year, is that the yield curve is flattening. So when the yield curve flattens, that spread between the 2-year and the 10-year interest rate is compressing. That means that growth expectations are falling. Why is that important? When the yield curve is rising, like we saw here, you want to buy cyclical assets like energy and steel stocks and commodities and consumer stocks. When it's falling, you want to actually buy secular growth stocks. In other words, stocks that don't need high growth to generate high earnings growth. So that's how we're focused on in terms of the overall asset allocation. And I think you're starting to see that in the way these assets have started to perform in the last 2 weeks. So just a reminder in terms of our general rules, when stocks are oversold and everyone's fearful, that is our high conviction buy zone. Those two conditions still exist today despite the rebound in the market over the last 4 to 5 days. You just need one down day like you've had here on Thursday to really bring everyone back into that fear camp. So right now, everyone's fearful, stocks are oversold, we're in the high conviction buy zone. And why do we say that? Well, the data suggests that. When we look at, this is the chart we used last week, when we look at the investor sentiment survey, we are in some of the most negative sentiment conditions, in other words, the most bearish conditions over the last, call it 12 to 13 years. So this negative 29.8 has only been superseded 3 other times: the 2008 financial crisis, the European financial crisis, and then the US debt downgrade. So when we get conditions like this, as we see here on the chart on the right, almost without a doubt, over the last 13 years, it's been a 100% win ratio. In other words, 3 months forward, the market is up, not down, when we see investor sentiment this low. And of course, when we get short-term action that was this violent to the downside in January, we want to buy the dip. And where do we see that? Let's look at the data. So when we look at the S&P 500 rolling 14-day returns. So in other words, the previous 14 days, what were those rolling 14-day returns? And what does the market do in the future when those rolling 14-day returns are really, really bad? So when we look here, this is the rolling 14-day return back in January. When we see these really bad conditions, in other words, 10% losses or greater, what we see here is the 3-month and the 6-month returns are very strong. In other words, the S&P 500's forward 3-month return is 7.1%, and the S&P 500 6-month forward return is positive 13%. That's really important when you compare it to if the rolling 14-day return was flat, it's on average only 1.8 and 3.8%. What's the bottom line message here? When the rolling 14-day returns are really bad, in other words, down 10% or more, the forward returns are very, very attractive from a 3-month and 6-month perspective. And we also know that money has to go somewhere, right? So a lot of the times we make this mistake of just saying the stock market looks really bad, stocks are going to sell off, or I'm not happy with what's taking place in DC or whatever the Federal Reserve is doing, and so I'm going to sell my stocks. But we have to remember a lot of the longer term direction of the stock market is predicated upon investors' options out there. In other words, what can they do with their money and which is the most attractive option? When bond yields are as low as they are, and they're still very low, remember, even at 2% on the 10-year interest rate, that's almost, if we strip out the pandemic, that's almost a historical record low. So what we look at is, are stocks cheap or are bonds cheap relative to each other, right? Because we can generally own stocks, bonds, or cash, and of course real estate, but real estate's more of an illiquid asset. So what do we know here? When the S&P 500 has a high earnings yield relative to the treasury yield, so the 10-year treasury yield, stocks are cheap versus bonds. When the S&P 500's earnings yield is less than the 10-year treasury yield, then stocks are expensive versus bonds. Right now, and as has been the case for the last decade, stocks are very cheap relative to bonds. So yes, we can get these pullbacks and these scary moments, even a 2020 event, but overall, money continues to gravitate towards stocks because guess what? Bonds are still only yielding 2% in a 5 to 6%, in some cases 7% inflationary environment. So do you want to take the loss, or do you want to buy an asset that is inflating higher than inflation over the long term? We choose the asset that gives us a chance to inflate higher than inflation. And that's the way we have to look at things in terms of selecting where we want to put our money. The other big thing is to look at which stocks have been hit the most. Right now, that's certainly within the NASDAQ, right? So when we look at the NASDAQ, more than 1,600 NASDAQ stocks have been cut in half, the most in 13 years. When I say cut in half, down by 50% or more. 1,600 NASDAQ stocks are down 50% or more. Within that group, you got some fantastic companies, you got some mediocre companies, and some downright crappy companies. We're trying to focus on those good to great companies within the NASDAQ. Now, in terms of that short-term trading action, this is not including Thursday's action, mind you, but we continue to see here is this was the low put in 3 Mondays ago. Then we had a higher low, we rallied, retested again at a third higher low, rallied, a fourth higher low, and then made a higher high. So what does that mean? When the NASDAQ or the S&P 500 or any index that you're focused on coming out of a correction is making those higher lows, each low is higher than the previous low, and each high is higher than the respective previous high, that is a positive trading signal. It means that, yes, every time we go higher, there's more sellers that come out to unload their shares, but it's being absorbed by more and more buyers. This is the type of healthy trading action that we want to see. S&P 500, very similar action. We had that wash lower in January. We all remember that painful moment. Strong bounce, retest, again, higher low, higher high, retest again for the second time, higher low, and then a small rally until we had another higher low, and then a big rally this week to higher highs. So higher highs and higher lows. That's what we want to see coming out of a correction. And then we see the same thing taking place with the VIX. So the VIX stands for volatility. So when we look at the overall demand for put options, which protect us against falling stock prices, versus call options, which go up with rising stock prices, what we see here is the VIX continues to fall, right? We talked last week about having those lower highs, which is what you want to see with VIX. Lower highs is a good thing when it comes to VIX. We saw a downright breakdown in the VIX this week. That means that those people who wanted insurance against stock losses are no longer showing up to buy volatility protection. And we see here in January, just the absolute mania or the mad rush to buy put options at any price. So when we see that type of action, we kind of want to lean against the action, go the other way, and start picking away and buying some valuable merchandise. And we see this again with the NASDAQ volatility, right? The NASDAQ was at the center of the storm, big shoot higher through 40, and we continue to make a lower high, that's good, and then a breakdown lower as the demand for NASDAQ protection continues to collapse. Now, within certain sectors, there's two sectors that have started to act a lot better. One's the consumer and the other is the biotech sector. Now, we currently don't have any exposure in biotech, but this is a sector we're increasingly looking at. It is a sector, when we go back over the last 12 years, is certainly trading in one of its worst drawdown periods, while the group of stocks underneath that are actually, fundamentally great companies. There's a collection of great companies within biotech. So right now, one of the most unloved sectors, but making those higher lows and higher highs. That's what we like to see. Consumer stocks trying to break out of this breakdown condition. And the last slide we got here is just talking about the overall distribution of wage gains in the economy. What we've heard a lot about how wage gains are out of control, but there's something in statistics calling the tail effect, right? So we always want to make sure that when we're looking at a stat, that stat is being pushed up or down or flat by most of the participants, or is a tail sort of just dragging the entire number higher or lower. And what we can see here is really most of the wage gains have been concentrated in the 10% or less categories across the economy in terms of industry categories. And that's having a dramatic impact on what we see as that wage growth number. So in other words, 22% of employment right now is leading to 13.6% of the wages. So a very narrow window of overall industries is pulling that wage number higher. And a lot of it's in sort of lower paid industries such as the service sector, restaurants, hotels, et cetera, where we would expect that. And that's where the shortages are right now. So overall, we continue to see these market adjustments when we get these new regimes, right? So when we're going from financial accommodation to financial restriction by the Federal Reserve, these regimes, when they change, lead to short-term but violent resets in the market, but they're often short-lived. And I think that's the key phrase here, short-lived. And this often presents an opportunity. So right now, fear and cash levels remain very high. So we want to lean in against this action, plug your nose, and buy or hold that valuable merchandise that we have. Number two, 4 to 5 interest rates appear to be priced in. We would even argue 6. So that is a green light to buy damaged goods. It's only if you think we're going to get 10 or 12 that there would be an increased move lower in risk assets. And then lastly, stocks across the board continue to make those higher lows and higher highs. Remember what we said, coming out of a correction, we want to see higher lows and higher highs with increased volume and participation. So that's what we got for you this week. If you have any questions, give us a call, give your advisor a call. We're here, 888-543-3776. And thank you again, and have a great weekend.